Hey there, welcome back to the channel. Today we're diving into a book that has been a game changer for so many investors. Common Sense on Mutual Funds by John C. Bogle. If you have ever been confused by the world of mutual funds and how to make your money grow, then you are in the right place. John Bogle, the founder of Vanguard, breaks down investing in a way that's simple, effective, and most importantly, reliable. So let's break down the key takeaways and principles from this book and show you how to make sense of it all. First up, Bogle is a big advocate of low-cost investing. He makes a powerful argument that the lower your cost, the lighter your returns in the long run. It sounds simple, right? Think of it like buying a meal. You want a hearty meal, but you don't want to be paying for a five-star restaurant where you can get the same ingredients at a lower price. The same goes for mutual funds. High fees eat into your investment returns over time, and that can make a huge difference, especially over decades. John Bogle recommended John Bogle recommends index funds, which track entire market indexes like the S&P 500 in the USA. These funds have much lower fees compared to actively managed funds, and historically, they have outperformed the majority of actively managed funds over time. And that is something you definitely don't want to miss. Which brings us to the second point, the power of index funds. Bogle is a pioneer of index investing. He founded Vanguard and created the first index fund for the average investor. Before this, investing was reserved for those who could afford to pay hefty fees to fund managers to pick stocks for them. But Bogle flipped that on its head. Instead of relying on a manager's stock picking skills, index funds simply mirror the performance of a stock market index. It is a more hands-off, less expensive, and more effective ways to invest. If you're a long-term investor, meaning you are in it for the ride and not trying to make a quick buck, index funds are your best friend. Next, Bogle emphasizes the importance of a long-term focus when it comes to the investing. So many investors panic when the market dips or when stock fluctuates in the short term. But Bogle says, don't swear it, stay in the game for the long haul. He gives the examples of how the stock market has always bounced back after crashes, whether it's the Great Depression or the 2008 financial crisis. Markets have proven to rebound over time. The key is patience, and if you're holding low-cost index funds, your investments will continue to grow as the market rises. Bogle often says, stay the course. It is all about that long-term commitment. By sticking with it, you allow the power of compounding to work for you. Let's talk about diversification. Bogle makes the point that investing in a variety of assets can help you reduce risk. Instead of putting all your money into one stock or one sector, a diversified portfolio spreads your investment across different stocks, bonds, and even international markets. Mutual funds are an easy way to get this diversification because they usually contain hundreds or even thousands of stocks in one fund. Bogle's advice is simple: diversify, diversify, and diversify. It is one of the best ways to protect yourself from unexpected market crashes. One of the biggest mistakes investors make, according to Bogle, is letting emotion dictate their decision. The fear of loss or the greed for quick gains can lead you to make poor choices. Instead, Bogle urges investors to avoid getting caught up in market hysteria and focus on their long-term goals. He shares stories of people who panicked during market crashes and sold their investments at wrong time. But the smart investors, the ones who stayed calm and held their investments, were the ones who profited in the long run. Remember, investing is a marathon, not a sprint. So Bogle also offers advice about financial advisors. He argues that while some advisors can be valuable, many of them charges high fees for services that may not add significant value. Instead, consider managing your own investments or using low-cost advisors that focus on indexing like Vanguard or other similar platforms. So, what is the takeaway from Common Sense of Mutual Funds by John C. Bogle? The first one, keep costs low to maximize returns. The second, invest in low cost index funds for steady long term growth. Third, focus on the long term and don't get distracted by short term market fluctuations. The fourth, diversify your investments to reduce risk. The fifth, control your emotions and avoid making impulsive decisions. The sixth, consider low cost advisors and take control of your own financial future. Bogle's advice has been revolutionary, and it's all about keeping it simple, keeping it low cost, and sticking to the basics. If you want to take control of your financial future, following his principles is a great place to start. Thanks for watching, and if you found this video summary helpful, don't forget to hit that like button, subscribe for more insights, and share this video with anyone who needs to hear these financial truths. And remember, investing is a journey. Stay the course and let's build wealth, one step at a time.